to you. Tell us a bit about the fund, please.
Excellent, thanks, James. So Octopus Renewables Infrastructure Trust, or ORIT, was launched back in late 2019 with a very successful IPO, raising £350 million. And what we're trying to do within ORIT is to give investors an attractive level of return, mostly through paying out a dividend, but also to give an additional element of capital growth. And I'll come on to how that works in a minute. So we're focused on renewable energy assets, particularly wind and solar generation in the UK, wider Europe and Australia. And we're aiming to deliver investors a 7 to 8% net return per annum over the medium to long term. If you look at what's happened over the 3.5 years or so since IPO, we've delivered a really successful portfolio. We've got a portfolio now of 919 megawatts, either in construction or operation, across 7 countries in Europe. We've had 2 successful fundraisers since IPO. So the market cap of ORIT is now roughly £600 million. We've been paying out dividends in line with our IPO targets for the first couple of years. And then since then, we've increased the dividend in line with either CPIH or CPI over the last 2 years. So we recently announced, or the board recently announced, an increase in the dividend target for this coming financial year ending December 2023 to 5.79 pence per share. And that represents a 10.5% increase compared with the 2022 dividend, so in line with CPI for the year. And we really recognise how important that inflation protection is to investors. And the board has been comfortable increasing the dividend in line with inflation because of the strong dividend cover that we've got now from the operational assets. We had a 1.8 times covered dividend for the half year at June. And when our full year numbers come out in a few weeks time, you'll be able to see again the strength of the dividend cover. Just before Christmas, ORIT entered the FTSE 250 less than 3 years after the IPO. So that was really pleasing for the team, and I think also brings greater liquidity to the shares, which is always good for investors. Looking at that portfolio of 919 megawatts, which I'll dig into in a bit more detail in a few slides' time, the value of that on a gross basis, including the debt associated with it, will be 1.3 billion once we've finished building all the projects we're currently building and followed through on all our commitments. And one important thing to note is we don't have any unfunded commitments whatsoever. We've recently extended the maturity of our debt facilities out for another 3 years, and so our construction and acquisition commitments are all fully funded by that RCF facility. On the right hand side of this slide, we've got a few things that we think set ORIT apart from what, as James has said, is a fairly crowded sector now in the renewables space. So ORIT was set up only 3 years ago, but the team at Octopus Energy Generation, where I sit, has been in this space now for about 12 years. And it's grown to be a really big team over that time. We've got over 100 people in the team. And that's not just people with finance backgrounds. We've got a lot of real energy sector specialists, people who've worked at turbine manufacturers, at construction companies, within the utilities. Now, have got real hands-on experience in managing these energy assets. And that's what enables us to do what we do, particularly, as we'll come on to, in delivering assets through construction. The next couple of points are why we think ORIT is quite different from a lot of the peer group. So we were set up day one to deliver diversification within the renewables sector. So we never wanted to be a single technology, single country fund. We wanted to deliver a mix of solar and wind, and we want to have diversification across geographies. Again, I'll come on in the next couple of slides as to why that's important. Next point, as to why we're different, is that we didn't want to be a yield co. So when you're looking at the yield you can get off these sort of products, we agree that there's some attractive yield there, But if you're just sat on a portfolio of operational assets, now that ultimately is a finite life asset. They're not necessarily going to run forever, and so your NAV will start declining over time. We don't want to be that sort of pure yield co. So what we can do by going into assets at the construction stage, we can deliver NAV growth through de-risking that construction, and that helps NAV. It helps avoid those NAV declines in the longer term. So we can keep paying out an attractive dividend that keeps growing, but we can also maintain and grow NAV through that construction allocation. A couple of years ago, we had a slight change to the mandate to allow us to invest in developers. Only 5% of gross asset value that we can do into developers. So that's people who are working on these renewable energy assets before they're ready to start construction. So securing a grid connection, securing all the planning permissions and all the land rights you need. And we really like that because it gives proprietary pipeline that ORIT then has the option to invest into when the projects are ready to build, but isn't required to. So we can secure what we think are really good value deals, but without having to make substantial commitments too early in the project life. And finally on this slide, ORIT is an impact fund, and we embed impact and ESG throughout all of our investment processes. We're an SFDR Article 9 product, and we expect when the sort of the UK new sustainable disclosure regimes has also been bottomed out, we'd expect to be a sustainable impact product under those new rules as well. So the next few slides, if we can move on to the next ones, just give a little bit more colour on those key differentiators. So you can see my face on this slide, but you can also see some of the wider team that work on ORIT on a day-to-day basis. I co-manage the fund with Chris Gaydon, but we've also got a wider team dedicated to ORIT, as well as having access to that team of over 100 people that I mentioned earlier, who've really got the dirt under their fingernails from building these assets, or have got the experience from working in utilities and power market advisors actually trading the power. So we've got that depth of expertise, and that's particularly important, as I say, when we're doing those slightly different things around construction, which really require that expertise to do well. If we move on then to the next slide, this gives a little bit more background on why we think diversification is just as important within the renewables sector as it is when investing more generally. We've focused on wind and solar as our core technologies, with at least 80% of the portfolio going into those. And we think those are the two technologies that are going to be the backbone of our power systems as we move forward into the new decarbonised world. So that's where there's the most opportunity. The reason we like having wind and solar together is there's actually a natural anti-correlation between their generation. Not only is it obviously more sunny and more solar generation in the summer, but also wind tends to be more weighted towards the winter. So it smooths out your cash flows over the year. But also when you're looking year to year, we've seen, for example, over the last year or two, lower than average wind speeds, particularly in Northern Europe. However, we've seen higher than average solar production. And that pattern, if you look back through the historical data, there's genuine anti-correlation there, which just helps reduce risk within the fund. We do look at some other technologies. We've got that up to 20% we can look at in other technologies. And at the moment, the areas we're most interested in there are in battery storage and potentially green hydrogen, which is another developing technology that we think is really an important part of the broader energy transition and quite complementary to renewable generation, just as battery storage is. On the geographical side of things, there's that same risk management approach. So if you have a year where it's less windy than average, say in the UK, you wouldn't expect to have the same pattern of wind speeds necessarily in Southern Europe or up in the Nordics. So by having assets spread over a greater area, you reduce those concentrations of risk to weather pattern. But we also think having that broad mandate geographically and the team that's able to originate and execute across the full breadth of that mandate because of the depth of experience and the depth of industry relationships, that really gives greater opportunity for growing the fund and growing it well. So we're not in a position where, in order to grow, we almost have to win every deal that comes to market in our individual geography. Because we're able to look across the whole of Europe and indeed Australia, we can see where there's best value, and we can also see where a government's doing the best job of incentivizing new renewables, the best job of dealing with some of those issues around grid connections that Andrew touched on earlier, and therefore capture the most opportunity and the best value for investors. Moving on then to the construction side of things and why we do that. As I touched on before, we really didn't want to sit there with a pure yieldco type structure. And by going in at the construction stage, one, we're helping decarbonisation that bit more by actually bringing new green generation onto the grid. But from an investor point of view, we're delivering NAV growth, because when we're valuing these assets using a discounted cash flow, we will have a higher discount rate for a construction asset to reflect that there are some risks that go with construction. We've got the team to manage those risks. On the bottom right of this slide, there's some figures around the track record of the team over the decade or more we've been going, and they successfully built almost £2.5 billion worth of assets across Europe and Australia. And on average, those have actually come in slightly under budget. So we've got the ability to manage these construction sites well. We've done that within ORIT on 4 wind farms so far, 1 in Sweden, 2 in Poland, and 1 in France. And we've got, therefore, 131 megawatts of the 919 that we've managed the construction, with a further over 120 megawatts coming through later this year. As I said, the reason we do that is because it's delivering additional NAV growth. We've delivered over £12 million of NAV uplift just through removing that construction risk premium from the discount rates through time. And that's with the Cumberhead wind farm and the Breach solar farm not yet complete. So more of that yet to come. So finally, on the sort of, sorry, a couple more slides on sort of those key differentiators before I give a bit more color on the portfolio that we've built. And these are the development stage investments. As I say, we do this for 2 reasons. One is going into those earlier stage investments gives us an opportunity to deliver higher returns. We only want to do that with a very small part of the portfolio because it does come with extra risk as well. But the other really important reason for these development stage investments is it gives us that access to future pipeline where we've got preferential rights to fund the construction. We've backed 3 development stage investments so far. I won't go into every single one of them in detail in the interest of time, but one perhaps to flag here is Simply Blue. So that is an Irish-based developer of floating offshore wind. So this is what we see as the next generation and how the world is going to evolve in the wind industry right across the world. If you think about where the most growth in wind has come over the last 5 years or so, it's absolutely been offshore, but in offshore wind farms that are directly in the seabed. But there's only so much seabed that's shallow enough to do that in a cost-effective way. And if we're going to be successful in delivering on net zero, we just need more. Floating is the answer to that, because you're then not constrained by seabed depth. And this is not new technology. This is technology that's effectively been used in the oil and gas industry for decades. It's technology that's already being used. So there are full-scale examples of floating offshore wind turbines out there right now. There's one off the coast of Aberdeenshire, for example. Really what needs to happen over the next 5 to 10 years is just bringing the cost of implementing that technology down through economies of scale, through supply chain. And in Simply Blue, we found a developer that's quickly, since we invested, become a world leader in this space. So we're really excited about this one and the opportunities, both for value growth and for further attractive deployment that may come in the future. Finally, then on the next slide, on those differentiators, if we click on, is the impact side of things. So we position ORIT as an impact fund because we are delivering that new generation through the development and construction stage activities. But importantly, we don't see impact or ESG as being any sort of cost to investors or coming with any sort of financial trade-off. And one of the reasons for that is when we're looking at these investments, we're applying ESG because we think it's really solid risk management. It helps us screen out assets that are at higher risk of running into problems, perhaps because of challenges from the local community, because the developer hasn't done things in the right way, challenges from environmental groups because actually the site's causing more harm than it's actually helping. So it's good risk management. We're screening things out. But also because we go above and beyond trying to look after the local environment, add value to the local communities around the sites that we're building, we think there's a real opportunity here. In our valuations, we assume these things work for 30, 40 years, and then we have to spend money taking them down. But in reality, we expect that there's a lot of these sites that can get repowered or extended over the years. And if we've been good corporate citizens along the way, then we've got a far higher chance of capturing that opportunity and delivering that extra value for investors. I've got a couple of slides now just on the portfolio, so you can see how that 919 megawatts is built up. The purple countries on the right-hand side here hopefully give a sense of the diversification point that I was touching on earlier. Our assets are spread out across Europe, so not concentrated to any individual country's weather patterns. The other really important thing that I want to draw out on this slide is just how we go about finding these opportunities. So what we really don't like doing is buying assets in highly competitive auction type processes where a seller has appointed a bank or a big four corporate finance team to canvass the whole market, drive a really competitive process and extract every sort of pound of value they can for the seller. All but one of these deals have come in processes that don't look anything like that. Either it's been a bilateral opportunity that we've been able to originate from our strong relationships, or it's a process where a developer has been running a sales process themselves and gone out to a handful of counterparties that they know and trust because they've worked with them before. And the only one investment on this portfolio where we have been in one of those highly competed advisor-led processes, we actually found out after the fact that we weren't the highest bidder on price in that process. Even then, we won the deal because of our credibility and the strength of our team in giving confidence to the seller that we'd actually deliver the site and get the deal done. The next slide just gives a bit of a sense of what's coming next. So we've talked about the construction side of things. You can see that the Cumberhead wind farm there is getting very close to the end of construction. We've actually got all 12 of 12 turbines installed. So the heavy lifting's done, and we're really now just focused on the commissioning, the final tests and checks that are needed to bring that site into full operations. And then later on this year, we should have the same happening for the Breach Solar site in Cambridgeshire. So people are on the ground now, putting the piles in to support the panels. Panels are going to start arriving on site in the next few weeks, and we're well on track for full operation of that site towards the end of the summer. You can also see on the bottom of this slide that we've got a couple of conditional acquisitions or forward purchase type transactions. One in Spain, where we will acquire a large portfolio of sites in southern Spain. If the developer is successful on getting them to a ready to build stage, that means getting effectively all the final environmental and planning permits that they need from the Spanish authorities. And then the bottom one is a large portfolio of sites just on the outskirts of Dublin in Ireland. Those are currently being built, actually just starting to be energized, and we'll acquire those once the site's fully constructed, probably around the middle of the year. So I've got just one final slide now summing up what I've run through there. You can, I suppose there's been a lot of noise in the energy sector over the last year with very high prices, some uncertainty about how governments are going to deal with that. We think that uncertainty is largely past. Governments have announced their windfall taxes or price caps, and we've got the team available now to really seize on the tailwinds in the renewables sector, which we view as being as strong as they ever have. Because building wind and solar is now not just the answer to net zero and decarbonisation, but it's also the answer to energy security and getting ourselves further away from reliance on things like Russian gas. And also it's a solution to the energy cost crisis, because wind and solar are the cheapest forms of electricity generation. So Orit's got that diversification, which we think is crucial from a risk management point of view. We can deliver additional NAV growth through the construction activities. We've got access to proprietary pipeline through the developer investments, and we're delivering impact and ESG as well.